Let's have a session on Edexcel Paper 2 for A-Level Business. So this is a topic recap video. The advanced information link is in the description box below. Make sure you check it out and know it inside out. Topic number 1, capacity utilization. So capacity utilization is a business output level as a percentage of the business's maximum capacity in a given period of time. The formula, current output divided by maximum possible output times by 100, as it's expressed as a percentage. So why low capacity utilization is bad for a business? High unit costs for the business, especially for a business with high fixed costs. More difficult to reach the break-even output, and capital is tied up in underutilized assets, for example, machinery. Why 100% capacity utilization is bad? Production is rushed due to high levels of demand, possibly a negative effect on quality, and also customer satisfaction. High workload for employees. It could be tiring, a large amount of pressure, and that could be demotivating. Inflexibility, therefore unable to respond to demand spikes. Lower sales could be conducted, and it could lead to lower market share. Ways of increasing capacity utilization. Reducing maximum capacity by relocating the business, dismissing idle staff, advertise, invest in capital machinery, or redeployment. For more details on capacity utilization, click the card up there. Topic number 2, liquidity. Liquidity is how much working capital a business has in the short term to pay off its short-term liabilities. Good liquidity means you have enough working capital to pay your bills. Cash is the most liquid of assets. Liquidity formulas to be on top of: the current ratio, that's current assets versus current liabilities. Remember, the current ratio should ideally be between 1.5 to 1 and 2 to 1. And also the acid test ratio, so that's current assets minus inventories divided by current liabilities, and the acid test ratio should ideally be between 1 to 1 to 1.5 to 1. Methods of bringing in cash and improving your liquidity: selling non-current assets, encourage cash sales, selling inventory, use contingency funds, overdrafts, bank loans as sources of finance, discount price, perhaps loss leaders, delay payments with payables, chase up debtors, receivables, insist on deposits, or use debt factoring. For details on acid test ratio, click the card up there. Topic 3, ratio analysis. Ratio analysis, finding relationships between financial data to assess the performance of the business. Of course, there's liquidity ratios, but also there are profitability ratios, which assess a business's ability to generate earnings compared to its expenses during a specific period of time. So you have return on capital employed, the profit made by a business as a percentage of the total amount of money invested, or capital employed. And the formula is operating profit divided by capital employed times by 100. And capital employed is non-current liabilities plus total equity. Net assets equals total equity, and the higher the ROCE, the better. More details on return of capital employed, click the card up there. Gearing ratio, examining how dependent a business's total value is on borrowed money, which affects the company's long-term financial position. Gearing as a percentage equals long-term liabilities divided by capital employed times by 100. The higher the gearing, the level of borrowing, the higher the risk to the business due to higher interest repayments. However, gearing can be a financially sound part of a business's capital structure, particularly if the business has strong, predictable cash flows. More details on the gearing ratio, click the card up there. Limitations of ratio analysis. Difficult to compare over time if the nature of the business has changed. Only useful if the financial accounts are accurate. Balance sheet is a snapshot, so different days may show different results, and it only relies on quantitative information. Additionally, window dressing affects the appearances of accounts. Topic number 4, budgets. A budget is a plan of income and expenditure over a period of time, whilst a deficit when the expenditure is greater than the receipts, a surplus when the receipts are greater than the expenditure. Types of budgets. There's an income budget, the agreed income of a business over a period of time. An expenditure budget, the agreed expenditure of a business over a period of time. A profit budget, which is the income budget minus the expenditure budget. Historical budgets are budgets based on past years and can be incremental. Advantages, realistic as they are based on past performance, and issues, assumes all factors are constant. For example, a freak occurrence could happen, changes in qualitative factors of business such as workforce improvements. Zero-based budgeting, where each department or manager is given zero and has to bid for funds. Advantages, money is spent efficiently on sensible things and not wasted. Issues, lack of flexibility, and therefore department may require finance immediately, for example, a demand spike, which bidding process may take too long for. Reasons businesses set budgets. They are a measure of spending and can be analysed, can be tools for raising finance, helps control spending, helps prioritise projects, and staff get delegated responsibility of handling budget, therefore feel empowered and valued by the business, and also more motivated to work. Variance analysis, the difference between planned and actual budget figures. Favourable variance, when the actual budget is better than the planned one, leading to higher profits or lower costs. Causes, lower competition, demand spikes, improved supplier relations. Adverse variance, when the actual budget is worse than the planned, leading to lower profits or higher costs. Causes, diseconomies of scale, increase in competition, supply side economic shocks, for example, a rise in oil prices. More details on variance analysis, click the card up there. Topic number 5, break even. Contribution per unit equals selling price per unit minus variable costs. Total contribution equals quantity times by contribution per unit, which is the selling price minus variable costs. Profit is total contribution minus fixed costs. Break even equals fixed costs divided by selling price minus variable costs. And margin of safety equals the number of sales minus the break-even output point. Benefits of break-even analysis. Allows a business to analyse the effect of increasing prices or lowering costs to achieve the break-even point faster. Therefore, it's used alongside elasticity calculations to help business maximise their sales revenue. Gives a target of output for workers to aspire towards, therefore motivated to achieve it and feel valued as part of the business dynamic. Produced at a lower cost and therefore lower prices to attract more customers. Issues with break-even analysis. Not suitable for a business with multiple products, therefore not good for comparisons, a waste of resources to create. Assumes output is constant and all units produced are sold, therefore it's inaccurate due to wastage and damaged products. Does not take into account freak occurrences, shocks, for example demand spikes or an economic downturn. Best of luck with paper 2.